This is Back Roads of Illinois server to farmers and ranchers in central Illinois and the Midwest on KSIR in Fort Morgan, Colorado. I am Cesar Delgado on the Markets Club podcast. Midterms are almost here in Washington, D.C., and the planting progress are underway in the Midwest like in Iowa and Illinois. But the nitrogen costs are higher than previously years. Of course, I talked to some people in the farm gate on fertilizer markets. We were talking about all of these issues with the chief economist for StoneX Financial Services. Arlan is going to be talking about the fertilizer dilemma with fuel prices. It's high for consumers and farmers as well. This is Back Roads of Illinois server to farmers and ranchers in central Illinois and the Midwest on KSIR in Fort Morgan, Colorado. Midterms are almost here in Washington, D.C., and the planting progress are underway in the Midwest like in Iowa and Illinois. But the nitrogen costs are higher than previously years. Of course, I talked to some people in the farm gate on fertilizer markets. We were talking about all of these issues with the chief economist for StoneX Financial Services. Hey, Arlan, how are you with this crazy time?
Yeah, these certainly are crazy times, and it, it's been a headline-driven markets. Certainly, each day the first thing we do is read the latest headlines. I never thought that I would operate by keeping the President of the United States' social media account open, but that's what I do, checking it frequently throughout the day. Because when President Trump posts something on social media, oftentimes it's a market moving affair. And when I see a big jump in the market, be it up or down, one of the first things I check actually is the president's Truth Social account to see if he posted something that's moving the markets, especially if I'm seeing a number of the markets moving at the same time. So there's a lot going on in the world with big implications, but most of the focus right now is on the war with Iran and the closure of the of Hormuz that has severely curtailed our world's energy supplies and our world's fertilizer supplies. And as high as prices for diesel and fertilizer are here in the United States, they're much higher in the rest of the world because that's where the shortages are most pronounced. Asia, for example, is most dependent on energy and fertilizer coming out of the Strait of Hormuz. Europe would be a close second. And the United States fares the best. We're least dependent on the Strait of Hormuz, but it is a world market. So when they're out of crude oil in Asia and their cash prices are 160, $170 a barrel, they're looking at where they can buy it. And in the United States, if it's only 90 or $100 a barrel, it pays them to try to buy from us. And so as they increase their purchases from us and our exports of crude oil are record high, then that raises our prices. And the same thing is happening with fertilizer. We've seen some fertilizer reverse direction to be re-exported, but for the most part, it's been limited so far. It has happened enough to affect our prices to help push prices higher. But fortunately, it hasn't happened as much as it could. Maybe it's because the fertilizer companies are worried about getting the ire of President Trump. I don't know. But for whatever reason, things could be much worse than they are. if we would allow those exports to go out to other countries, further tightening our supplies. Unfortunately, that hasn't happened yet to this point.
Yeah, it is pretty overwhelming to our farmers. Of course, this is a pretty scary decade.
Absolutely, it is. It certainly adds stress. You have the financial stress of high input costs and suppressed grain and oilseed prices, although grain and oilseed prices are trending higher, and there's some reasons for that. But the high input costs certainly create stress. And then when you have uncertainty and volatility in headlines like you do, that just adds to the emotional stress on top of the financial stress that farmers feel right now.
All right, Harlan. The midterm season is here and the fertilizer prices are currently unstable. We see that for right now. What is your thoughts with this midterms about affordability issue of food costs and gas prices?
That's a couple of questions mixed in there, and I'm going to separate it out a little bit. With energy prices, keep in mind that when the Strait of Hormuz closed down, when we struck Iran on February 28th, and Iran closed the strait shortly thereafter, the last of the ships that exited prior to the strait being closed landed at their port of call on April 9th. So that was a good 5 weeks plus later. So if the strait were to reopen tomorrow, that means that ships that were loaded couldn't arrive at those same locations for another 5 plus weeks. So we're going to continue to see things get worse before they get better, even if the strait opens now. And right now, there are serious questions about whether that'll actually happen or not. So, from an energy standpoint, we anticipate things getting worse before they get better. And that's certainly something that should be on the top of every farmer's mind, because one of the places we'll likely see that play out the most is in the diesel market, is we're exporting diesel now to try to fill some of the deficits in other parts of the world that exist. So that's a real concern. Similarly, fertilizer. But for energy, for diesel, for example, that's an immediate problem here in the weeks ahead. The fertilizer problem, it's more of a next year story. Yes, if we see more exports of fertilizer, it's possible we could run into some problems with tightness of availability for side dressing yet. But for the most part, this is a next year story. Now, we are seeing some other countries, uh, like in Europe, Ukraine, parts of Asia, where they're cutting back corn acres this year. We may see reduced yields from reduced application, but the real story comes next year and about paying the high fertilizer prices next year and what supplies will be next year. The fertilizer story is more of a long-term story. And so from that standpoint, I think the impact, if there is one on food prices, is more of a 1 to 2 years out story. But the price of gas at the pumps has the biggest impact, that in food prices, on consumer sentiment. And we just had a consumer sentiment survey results released by the conference board indicating that consumer sentiment had actually bumped a little bit higher this month, but consumers are still very worried about gas prices and overall inflation in the war in Iran. And I say that as you break it down, we actually saw a little bit of a pickup. Well, I say that the consumer sentiment remains pretty strong among Republicans. Sentiment is lower, much lower for Democrats, but it ticked higher in the month of April. But with independents, it actually ticked lower again. And it's those independent voters that Trump really needs for trying to hang on to Congress in the midterm elections. Typically, the party in the White House loses votes, losing loses members in both the House and the Senate in the midterms, and the Republicans have very low margins. They can't afford to lose anyone at all without losing the House or Senate, essentially. And so this is a big concern for President Trump, and something that I think if we could get a war, a peace agreement in the Middle East, we'd probably see uh, more, shall we say, less volatility from President Trump and other policy areas going forward. But I think ending the war in Iran is going to be a difficult challenge for him and create some challenges for the midterm elections.
What is your prediction on this midterms about affordability issue and lack of demand for gasoline, groceries prices?
Yeah, I think grocery prices will probably be much less of an inflation issue than the gasoline prices. Gasoline is something that consumers tend to be very sensitive to. The question is, will they feel like avoidance of a nuclear disaster, getting not allowing Iran to have nuclear warheads, will they make that a connection or not? And that's what President Trump will be trying to do, is trying to connect, okay, higher gas prices is a small price to pay for being safe from a nuclear attack. But will he be successful at doing that? That's yet to be seen. That'll be in the voters' hands, and I think that'll be a real challenge for him.
Bean supply are lower than previously years. Of course, we see that about the trade dilemma with China and other countries. How is your thoughts on this meeting on next month with Xi?
I believe that President Xi and President Trump both want this meeting to happen. I think they're both positioning ahead of it. I think their negotiators are talking on nearly a daily basis, even though it's not reported that way. And I fully expect that they will meet unless the war with Iran is in a place where President Trump feels like he needs to be in the Situation Room. And if they do meet, I expect some type of a trade deal. I do not expect soybeans to have a meaningful place in that trade deal. China doesn't need our soybeans. They're much more expensive than Brazil's. They would have to go into the reserve, which is we believe to be full. So I don't expect it to be soybeans. And all the indications we're getting from China would seem to indicate that as well. But I do expect China to offer to buy other ag commodities in an attempt to try to get concessions from President Trump that would ease pressure on China's economy. What that would be, probably wheat, particularly milling quality wheat, perhaps corn, perhaps ethanol. I don't know. We're not seeing any direct indications of that, but I think that's possible. Uh, I think they would buy our beef, but I don't think President Trump will allow them to buy our beef because he's worried about high beef prices here in the United States. Perhaps they might increase pork, but they're already buying quite a bit of pork. Um, Perhaps some poultry, more grain sorghum. But corn is something that they do have room for. They don't need to import our corn, but they do have room for our corn in their reserve. And therefore, I think that's a possibility, both corn and ethanol. And if so, that could have a significant implication for the markets in the months ahead if corn were to be added into there. And wheat, particularly if it's milling quality wheat, could have a significant implications as well in light of the drought that we have in the plains right now affecting the hard red winter wheat crop.
What is your position on November beans for right now with this meeting, Arlan?
If in fact there are no additional old crop soybeans in the trade deal, then we have more than enough soybeans to get to the next harvest. The only question would be, and that's one reason we've been seeing old crop prices lose ground to the new crop contracts of late, because the market is shifting toward more concern about growing enough beans for the next marketing year, for the 2027 RVO requirements for biomass diesel production. And so that's the primary focus. If there are substantial quantities of soybeans, old crop soybeans that are in this deal, then that totally changes things. But I don't expect that. One of the things I'll be watching for is back in October, China promised to buy 12 million metric tons of US soybeans in the current marketing year and 25 million metric tons in each of the next 3 years. I fully expect that 25 million metric tons for the next marketing year and the 2 years after that to be renegotiated. Is this the time that they will renegotiate it? And if so, what to what that level? In my balance sheet right now, I only have them buying about 12 million metric tons, similar to this year. Um, it could be less than that. It could be more than that. But I don't expect them to buy the 25 million metric tons. But the good news is, with the strength of this biofuel program, I don't expect us to have 25 million metric tons available to export to them. So I think that we're shifting from an export-oriented soybean market to a domestic demand-oriented soybean market. The acres that USDA said we would plant on March 31 to soybeans, I expect that to grow. I expect an additional modest shift from corn to soybeans that'll show up in the June balance sheet. And if they only buy 25 million metric tons with the limitations on our crush capacity, I think that'll be enough. But there'll probably still be concerns about possible weather scares this summer, but in an El Nino year, those tend to be fewer and farther between. So at this point, I think that May 14 and 15 summit between President Trump and President Xi will have a big impact as I look to, are there any old crop soybeans left in it? I don't expect them, but there could be. And do they use this as an opportunity to negotiate down the 25 million metric tons for next year? But if they do that, then I would expect them to increase other ag commodities that they would purchase in that agreement, because their big concern is getting enough concessions from President Trump to help boost their economy. And that, so they need to impress him with what they do buy as a total package.
Arlan, some people are concerned about the beef demand from the economy in general. As a chief economist, do you have a lot of concern about the economy in a whole?
I really do not. I think the economy is doing well. There are sectors of the economy that are struggling. The housing market, for example, has been in a recession, has been struggling. We're seeing some early indications of possibly seeing some improvement there, but it's still got a lot of problems. The ag economy has certainly been struggling. The economy as a whole, though, is seeing some very positive signs, better than what consumer surveys show. Particularly this month, we're seeing some of the manufacturing surveys show increase in demand, increase in hours worked, some of them showing improvement in employment. A lot of positives starting to show up there. And so I think that if we could bring an end to the war in Iran, that we would see a lot of strength in the economy.
What is the fundamentals trends in the feeder markets?
As we look at the feeder markets, we're still seeing good demand for protein, meat. In the hog sector right now, we're adequately supplied, but we're anticipating here in the weeks ahead, we'll start to see that seasonal decline in numbers available to slaughter. On the cattle side, we did come into some pressure here last week, um, fearing that Secretary Rollins was about to reopen, at least partially, the border with Mexico to allow more cattle into the United States. But that looks to have been put on the back burner once again. So the cattle market's been coming back. We've been seeing a return to some strength in the cash market as a result. The consumer continues to buy beef at these high prices. That's supporting demand for beef. And right now, the the packers are hoping that they'll see some of these recently improved margins, not as negative as what they were previously, improve a little bit more. Hopefully, with barbecue season upon us, that we're seeing some signs of increased demand. The three biggest weekends for barbecue are Mother's Day, Father's Day, and the 4th of July. And those still sit ahead of us and are supporting demand for beef. But we've seen pork supplies, particularly some cuts like hams and butts that have been improving. When you look at other products like pork bellies, bacon decreasing or not increasing at the pace we would normally expect this time of year. You look at beef, pork, and poultry supplies all together, they continue to tighten up as consumer demand for protein remains strong. And ultimately, that's the underlying factor supporting these markets is that strong demand for protein from the U.S. consumer. U.S. consumer continues to complain about how bad the economy is, but they continue to pack out the steakhouses. And that's had a big impact on our cattle market.
What is your final thoughts on this planting intention report on June and the midterm season in the agricultural industry?
My final thoughts would be that I'm less pessimistic than what I was. Obviously, I'm concerned about diesel prices. I'm concerned about fertilizer prices. But I think we're in a little better position now than we were in a few months ago from the standpoint of demand for the products that we produce. And not that I'm bullish at this point, but I certainly think that we've elevated the floor underneath of these markets somewhat because of the fears of inflation and fertilizer shortages have brought more money into these markets. So we are managing the supply and demand at a higher price than what we would otherwise. And we have opened the door to the possibility of some bull moves in the market. They won't necessarily happen, but we've increased the chances that they could happen. And so I do have a better feeling for these markets or better feeling about these markets going forward. I still think we need to be diligent in managing our risk on the farm, but I think we'll see some better opportunities to do that.
Thanks, Arlan. It's pretty crazy time in the world, but we hope for the best.
Well, thank you, Cesar. It's been my privilege and honor to be a part of the podcast again today, and I wish you well.
Thanks again. This is the Chief Economist for StoneX Financial Services, Arlan Sundermann on back roads of Illinois.